Good afternoon, everyone. Thank you for attending this. I think it'll be really helpful. We're going to just start off by introducing us. We're Pursuit. We're a community-focused lender. Our mission is simple. We like to provide businesses with affordable loans and resources to help you grow and to achieve your goals. We have over 65 years of history offering unique, innovating lending solutions to help you achieve these. We provide a streamlined path to business funding, and you can directly access over 15 loan programs through our single lending program. Today, I'm Krista Periton. I'm a Vice President and Commercial Loan Officer in the Manhattan office. And we have Jim Conroy, who's an Executive Vice President, and he's the President of the 504.
Great. Thank you all very much for joining us today. Krista, thanks for the introduction. The program is intended to really go into detail about the 504 refinance program, but I think it's important for us to first talk about the program itself, the 504 program, as normally used for expansion projects. And then the refinance rules have recently come out that allow us that enhanced benefit for using projects that are refinance related for the 504 program. So we'll go through what the benefits of the 504 program are first, then we'll talk specifically about the eligibility criteria for the 504 refinance program, and then we'll go into a few case studies and examples on how it is that maybe the program can be used by you or others. So first and foremost, one of the most important things to communicate is that the 504 program is perhaps the best economic development financing tool available to small businesses today. It is intended to help small businesses make a fixed asset acquisition. Usually we're talking about real estate or sizable equipment, and to do so in a way that is not only in the best interest of the company in managing cash flow, in providing flexible terms, but also does the 504 program also is involved with a bank in the financing as well, because it's critically important that a borrower not only get the best financing terms possible as they're growing and expanding, but also to establish a key banking relationship. So what we try to convey to anyone who listen is that the 504 program really should be considered for any eligible project that's possible. Some of the best repayment terms available through the 504 program are outlined here, and they match up against a traditional mortgage. So if you were to go into any bank and your business is going to buy a piece of owner-occupied commercial real estate, the bank is likely going to tell you you have to put 20% equity down. And the terms and rates that the bank may charge, they may have a 10-year term with a 20-year amortization. So you're making payments as though it's a 20-year term, but in a 10-year period of time, you have a balloon. And the interest rates are usually 5-year fixed and will adjust after the first 5 years to the 10-year maturity. And while you can use that program or the traditional mortgage for not only a purchase, but also for renovation and expansion, you can also use it for refinance. The 504, by comparison, you don't have to put as much as 20% down. You could be as low as 10% down. So there's minimum equity contribution. That's a hallmark of the program that makes it more advantageous for small business borrowers. Another benefit is that the term, if it's a real estate project, you really want to stretch the term as long as you possibly can. And the 504 has a 25-year term. Now that's a fully amortizing term. So there's no balloon feature. It's a 25-year maturity, and it's a 25-year term, so there's no balloon feature in there. The interest rate also is fixed for the entire 25 years. So there's a 5-year adjustment in traditional mortgages. The 504 is a fixed rate for the entire 25 years. And while that's particularly good in most situations, it's especially good today as we're experiencing some of the lowest rates in the program's history and historically low rates in the market in general. Now, the one issue here that's really kind of worth emphasizing is that in order to access a 504, you have to work through a certified development company, or CDC. And there's about 200 CDCs in the United States. Our company operates in New York, New Jersey, and Pennsylvania. And we're traditionally in the top 5 in terms of 504 volume in the United States. So we're an SBA 504 certified development company. You can feel comfortable when you're working with us that you have competent processing as well as the most professional application process possible for your loan application. And as I mentioned, and as the point of this whole webinar, is it now can be used also a 504 for a refinance project.
So we're going to start, sorry.
Go ahead.
I was going to lead into it saying we're going to start off with this. I just want to jump in and say, if you guys have any questions, we can look at the end. If you have a specific question to your company or a loan you're seeking, we'll have an email at the end that you can email, and then we can talk to you directly. But all questions will be held to the end.
Great, thanks for that. So what is the eligibility requirement for a 504? I mentioned it has to be a fixed asset transaction. Probably about 90% or even more of our projects are commercial real estate transactions. So it's an owner-occupied commercial real estate transaction is what has to be in place for it to be eligible. And owner-occupied means that the business is going to occupy at least 51% of an existing building or 60% of a to-be-constructed building. So if it's a small business that's been operating for a while, wants to buy a piece of commercial real estate, and they're going to occupy a majority of the space with their business, you will likely be eligible for a 504 loan. This is an important element not only for expansion 504 projects, but also for a refinance eligibility issue that we'll get to in a minute. So the way that the 504 works, I mentioned 90% financing. The 10% equity is the borrower's contribution, but 50% of the project is provided by a bank in a first mortgage position. The 504 is actually a second mortgage that does 40% of the project cost. So the 25-year fixed rate, the lower rate is pertaining to the second mortgage, the 504 second mortgage that's identified here. There are a couple of situations in which the equity contribution can be modified. If it's either a startup business, that is, it's been in existence for less than 2 years, or it's a special purpose real estate project, like a gas station or an indoor ice rink or a hotel, then the equity contribution is increased from 10% to 15%. If it's both a startup and a special use property, then the equity goes from 10% to 20%. And you'll notice that the bank first mortgage remains constant at 50%. As the equity increases, the 504 second mortgage decreases proportionally. That being said, even if it's a higher equity requirement, it's still considerably less than what you would likely be required to put down if you were going to a bank for a conventional mortgage transaction. So in talking about go ahead, Krista, sorry.
No, I was just going to say for the special use properties, it's obviously, you mentioned a few, that's just a specific list. So if you ever need to know if there's a special use, we have a specific list. So that's something we can give you right from this, the jump. It's not like we have to determine it and submit it and then that's determined. It's something we have right then and there.
Right. So the 504 program is now available for refinance projects as well. And this is particularly exciting because I think with the current rates and terms that we're talking about, there's probably a double or triple of the number of applications that we may see in the coming years and months as more and more people become aware of this program. So basically the same premise exists with the refinance program as it does with the expansion 504 program. You can use this to refinance debt that is on commercial real estate or fixed assets that are owner occupied if it's a commercial real estate transaction, and the debt was used for an eligible business or an eligible project cost, which we'll get to in a minute. You can also not only refinance the existing mortgage debt, you can also cash out some portion of the equity that exists in the property to be used for eligible business expenses like working capital. So it could be maybe purchasing inventory or covering utility costs or salaries for new employees. Could be a number of different things that you want to use eligible business expenses for. If there's enough equity in your property, you can add that to the project that's being financed in addition to refinancing the existing mortgage debt. Now, this still requires us to have a bank partner as part of this project. So a bank will still provide a first mortgage and the 504 will be in a second mortgage, but it's structured very similar to the way an expansion 504 project would be structured. So to qualify, your business needs to have been in operation for at least 2 years, and you must have what's called a qualified debt. And a qualified debt has to have been in existence for at least 6 months, and it has to have been used for an eligible 504 project cost when it was initially booked. Now, this is a little bit of a difficult thing to explain, but if your most recent transaction is a refinance of a loan that was refinanced, of a loan that was refinanced, of a loan that was originally used to buy your owner-occupied commercial real estate, despite the fact that maybe the use of funds in the most recent transaction is not directly tied to the purchase of the real estate, so long as we can go back and verify that the original loan that was refinanced multiple times was used for an eligible 504 project cost, then it is eligible. I realize that might be a little difficult to wrap your head around at this point, but just think about it as though if the loan was originally used, no matter when it was booked, originally used for an eligible 504 project cost, and we can document that, then you can qualify for a 504 refinance loan. A very recent change that is very positive is that the refinance debt or the qualified debt could also have existing SBA or USDA guarantees attached to it, and can even be an existing 504 loan. So even if it's an existing SBA transaction or an existing 504 transaction, we could refinance that debt into this new transaction. So I mentioned before about a lot of deals probably coming our way in the coming months. A lot of them might very well be businesses that we have existing loans to, where after 6 or 7 years, perhaps the interest rate environment is low enough now to refinance that debt and put it out over a longer maturity and lower interest rates. So this is an indication of just how significant a benefit this 504 program may be in the coming months.
And I do want to just jump in and confirm, just that I did see a question. So that doesn't count for an EIDL loan. That's separate. We're talking about existing 7A or 504 loans only.
Yeah, good point. And I think the SBA has done an amazing job over the course of the pandemic to provide access to capital for small businesses, whether it's the PPP program or the EIDL program or payment relief that they provided to existing SBA borrowers. The agency deserves an awful lot of credit for what they've been able to do and helps millions of small business owners through the pandemic. So we added a couple of slides here to just try and understand the loan to value requirements. So this 504 refinance plus any cash out, the 504 second mortgage can't be any more than a 90% loan to value. If there's eligible business expenses that are rolled into the project, our maximum loan to value is 85%. So the way that you determine the loan to value is you take the current debt that you're going to have on the property and divide that by the appraised value of the property to come up with a ratio. So in this case, if you have an existing building and the market value via an appraisal says it's worth $800,000 and you owe $400,000 in mortgage debt, that mortgage loan has a loan to value of 50%. So if we were to refinance this $400,000 loan and include up to 20% of the value of the property as eligible business expenses, then your total borrowing would be $560,000, which we could do through a first mortgage from a bank, and the 504 would be a second mortgage through us. The borrower would walk away from the closing table with $160,000 of cash to use for eligible business expenses. And if the building were appraised for $800,000, the $280,000 first mortgage plus the $280,000 second mortgage is $560,000. With a building worth $800,000, the loan to value is 70%. So we would be under the 85% cap that the SBA requires. So that's a simple example of how the 504 could not only refinance existing debt, but also provide additional cash out money and working capital for eligible business expenses. So for businesses out there, this is a program that we market very heavily to banks. They're pretty well aware of it, but it's exciting to have an opportunity with webinars to make the presentation directly to the business owners. You might be curious how it is that you can get started in terms of getting an application going. We really don't want to see ourselves as a competitor with lenders. Obviously, we need a bank to be in a first mortgage. So usually what we would recommend is if you have an interest in doing a 504 refinance, to not only bring the deal to our attention, but also mention it to your existing bank that you're looking to refinance the debt. And we can work collaboratively with them to do a 504 loan as a refinance option for your small business. We also, if you don't have a current bank or the existing bank that you're working with is not interested in helping with the 504 refinance, we can put you in touch with other lenders that might be willing to help you. So a couple of examples. This one is probably a poster child for a 504 refinance. What happened was this is a business that had run into some difficulties in operating their business. They had a concentration in their sales, and the company that they had a concentration in sales to went out of business. So as a result, they had a real difficult year operating wise, and they had run up their line of credit to their existing bank. They had done some other short-term borrowing needs to help them through the difficult times. And they had done a really good job at going back out and marketing their products to a diverse group of customers so that they wouldn't be in a situation like this again, where just one customer's demise really had a profound impact on their business. However, by the time they did that, they realized that their lines of credit were pretty high. Their debt to worth ratios and some of their cash flow ratios were not good. And despite the fact that they had turned the corner and were doing a pretty good job, their incumbent bank was a little nervous about making them an additional loan. So with the 504 refinance, they actually had 3 properties, and we refinanced mortgages that existed on all 3 properties and provided cash out that allowed them to pay down their line of credit, pay down their payables, and increase the funding available for them to dig themselves out of the problem that they had. At the same time, we also reduced their monthly payments on their debts by $30,000, which was a very significant benefit to this company. And all the while doing this, we were able to not only help the small business, but the existing bank that had this relationship, the ratios had improved dramatically as a result of our refinance, and that existing bank really didn't have to lay out too much additional money to help the company. So they were able to help their customer, retain the customer, and do it in a way that didn't increase their exposure to a business that they were a little nervous about how they were going to come out of the downturn that they had experienced. I'm happy to report that they're doing very well today. Another example is a restaurant that was operating for a short period of time, and they bought their existing property with seller financing. So the seller acted as their bank, and they were making payments over a period of months and years to that landlord. But what happened was the pandemic occurred, and these folks had also decided to do an expansion just before the COVID crisis hit. So they were in a pretty precarious situation. They had pivoted very nicely to an online and pickup option for food service, so their operations were doing pretty well. But we were able to refinance the seller debt and put it into a 504 refinance, which not only allowed them to reduce their monthly payments, but also take out some equity that they had in the property that allowed them to weather the COVID downturn much more effectively and manage that expansion project without being too much of a drain on their overall operations. So this also, the refinance resulted in them having less payments per month on their mortgage debt to us versus the mortgage payments that they were making to the seller. So it really worked out well in helping them. So those are two examples on kind of maybe the extreme side of where the 504 refinance can be most helpful. But there's dozens of other examples, including maybe those of you who are on the phone that might have great examples that we can show in future presentations where the 504 refinance option is a tremendously helpful product. So to conclude, the 504 refinance program is available to businesses through our company in New York, New Jersey, and Pennsylvania. We have a website as well as a contact email and phone number to discuss eligibility of your project. And at this point, we'll open it up to any questions that you have through the chat channel.
So I do see we have a few questions. I'll let Jim reiterate. So the one question we have is, can it be eligible for a construction loan? Which Jim did, kind of touch on the uses, but if you want to continue with that, just to see exactly what's eligible along with the eligible business expenses.
Sure. So yes, if it's a construction loan, what ends up happening is this would be a new 504 project, which I kind of discussed at the very beginning of the presentation. So we take your land acquisition costs, your construction costs. We can even roll in some of your soft costs, like the cost for appraisal, environmental, title insurance, etc. And we take that entire package, have a total number, and that's what we work the 50, 40, 10 percentages off of. If you're doing a refinance of an existing building and you're doing an expansion, we can do that as well, where it would be the expansion money would be part of the project and a refinance of your existing debt would be part of the project as well. There's a different way of structuring it, but in either situation, the answer to your question is yes, that we can include a construction project in the 504 program.
And to add on to this, because this is kind of another question that asks if the renovations can be used for that cash out eligible business expenses, that's separate. As Jim said, that's for more actual business expenses such as like salaries, utilities. So that is a separate cost.
Right. This refinance program, there's two different ones. There's a refinance with expansion, which is kind of what we were just talking about, where you have an existing property that has a mortgage, but you want to do an expansion. We can do a 504 on that. And then there's refinance without expansion, which is the one that I just was discussing, where you could use eligible business expenses for cash out. You could not use renovations for a 504 refinance without expansion.
Right. Somebody did ask, can it be eligible for a condo? So yes, and to go off of that, anything that a 504 loan is eligible for, the refinance is eligible for. So it's that fixed asset. So we can do co-op and condo units as well. So that is to refinance any debt that you could have used for an actual 504 loan. There's some specific questions on, credit score. These are all different types of eligibility items. So Jim, feel free to jump in if I'm wrong, but what we're focusing on is mainly the actual refi rules. All of that is part of what we do in our due diligence at the time of the credit. So we don't necessarily have a specific number. If you have a lower credit score, it's something we tackle at that time. We get the storyline, we make sure you're up to date. You have no, payments owed to the government. So that's more specific to the actual eligibility. And like I said, we do that due diligence at the time of the report.
Yeah, it's important to realize that our company and the SBA, our mission is to try and provide creative financing to help small businesses. So even if you have a blemish on your credit report or something, that makes it difficult for someone just to say automatically yes, we fully investigate that, and we're not going to tell you just categorically that we can't help you. We'll try and figure out ways in which we can still provide some assistance. So, I think it's important for you to bring to our attention as early as possible what issues you may have, and then we can suggest, next paths. In some cases, I've worked with people where maybe it's something we can't do today, but they come back in 6 months or a year after repairing their credit and maybe making some changes to their balance sheet in a way that makes them a lot more palatable for approval. So our credit approval process is something that we definitely understand that in a lot of cases there might be some issues that we have to explain and get behind before we can say yes to. But don't let that detract you from making an application or having a conversation.
Exactly. So another question someone asked on the timeline, that is something, again, that's more specific to your loan. We obviously work as fast as we can. We can give you somewhat of a turnaround time with the SBA at the time we submit. It really depends on the complexity and what we're dealing with. So that is a pretty open-ended answer, but I do know someone asked that. So once we start your loan and kind of get a look at, if you have a lot of other companies we have to analyze, or it's a very complex project, that's something we handle at the time, and we can give you a general timeline. We never have a specific timeline, but that's something, we will discuss at the time of your loan. And then another person asked about interest rate. So, and if we could go into more detail on that, but the interest rate is determined at the time your loan is funded. So we could give you what the interest rate is as of today, which is what we always do when we start the loan, but it will be determined after the fact once your loan actually funds. So that's something to keep in mind with the interest rate. It's subject to change slightly. And let's see, some other questions are specific. So like I said, I would definitely email. Someone did ask saying they would have to find a bank. Again, we could, like Jim said, that's something we could provide you with a few options. We work with anyone. As he said, we don't compete. If you have a bank you want to work with, we'll work with them. If you need options, we can give you specific contacts to regional managers we know, or SBA department within a bank, and we will work with them and give you that. Someone asked about some business expenses that are eligible within it. So those eligible business expenses, like we said, includes salaries, utilities, inventory. There's more, but it includes a good amount of actual expenses. And I believe We have a question about a prepayment penalty. There is a prepayment penalty. It is a little complicated to discuss, Jim. I don't know if you want to go into it, but what I usually do is at the time, once I have your loan numbers, I can give you what the breakdown would be for the 10-year penalty. It does get a little complicated to talk about, but there is a prepayment penalty.
Yeah, one of the important things, as the interest rate has gone down in recent years to near historic lows, the prepayment penalty is based in large part on the interest rate that's being charged. So not only is there is a 10-year prepayment penalty on the 504 loan, but it declines over that 10-year period, and because the interest rates are so low, the prepayment penalty is really not as big an obstacle as you might think it would be, given the current low rate environment.
Another few people asked about the maximum 504 amount. So that's, we have a $5 million gross debenture. That doesn't say that we can't take on loans that are larger. It's just we're maxed out at that amount. So there would either be, we would put in additional equity, but that is our maximum amount. And that includes if you have other loans with us. So just keep that in mind, but that's the aggregate amount. Let's see what we have. There's a few other questions. The bank side of the loan, 20 over 25 years, it's generally 10 over 25 years. They can do, I believe, and Jim, correct me if I'm wrong, they can do 5 and do a reset, but it's 10 over 25. If our fixed is at 25 as well, yes.
The bank, if we're a 25-year maturity, the bank has to have a 10-year maturity on their first mortgage, but they could have a longer amortization, like I mentioned, maybe a 10-year term with a 20-year amortization or even a 25-year amortization. Sometimes they try and match repayments with our loan. But it's not going to be fixed for 25 years like ours. So it's not going to be as advantageous, but having our mortgage in a second, not only is that good for affordability, but it's also good because if you come up on that 10-year maturity, you can refinance the bank out relatively easily because the 504 is in a subordinate position. So I mentioned, the SBA would be at a 90% loan to value, but the bank is at a 50% loan to value. So if you want to refinance that debt, the bank debt, at any point, it's relatively easy for a bank to write a loan where they have a 50% loan to value, and they enjoy that because the 504 is in a second mortgage position.
And then I see, like I said, the other questions are a little bit specific. So please reach out to that number that we provided you or the email, and somebody will get back to you. If you want to speak to Jim or I directly, they could always forward that to us, and we'd be happy to discuss more. But I think that's all we have right now for the generalized question. So if I missed it, again, please call or email, and we will discuss it.
Great. Thank you, Krista. Thank you very much. Thanks you all for attending. This will be recorded and forwarded to everyone, as was mentioned earlier. So thank you for participating. Hope to hear from you again, and hope you found this helpful. Thank you.
Thank you, everyone.